Most people think saving money and investing money are the same habit. They're not. One protects you, the other grows you. And the gap between the two is where most people get stuck, sometimes for years. A savings account is a holding pen. It's safe, predictable, and almost flat. Investing is a different machine entirely, one built on risk, time, and compounding. Here's the part nobody tells you. Inflation is quietly working against your savings every single day. Money sitting still doesn't just fail to grow, it slowly loses value. So why do so many people stay stuck in saving mode? It's not a math problem, it's a psychology problem. Saving feels safe, investing feels uncertain, and our brains are wired to avoid uncertainty, even when it costs us. History backs this up. Through crashes, recessions, and recoveries, markets have always moved in cycles. But zoomed out far enough, the long-term trend has consistently pointed up. So let's make this practical. Here's the actual path from saver to investor. 5 steps, in order. Step 1. Build your safety net first. Before you invest a single dollar, you need 3 to 6 months of expenses set aside. This fund isn't an investment, it's insurance. It's what stops a car repair or a lost job from forcing you to sell your investments at the worst possible time. Step 2. Define what you're actually investing for. Retirement in 30 years and a house deposit in 3 need completely different strategies. Your timeline decides your risk. Short-term goals need stability. Long-term goals can absorb volatility. Confusing the two is one of the most common and costly mistakes investors make. Step 3. Understand the basic vehicles before you touch any of them. Stocks, bonds, and index funds aren't interchangeable. Each one carries a different risk and reward profile. Index funds in particular solve a problem most new investors don't even know they have. Picking individual winners is hard, even for professionals. Owning the whole market sidesteps that entirely. Step 4. Start small and start now. Waiting for the perfect amount of money or the perfect market moment is the single biggest reason people delay investing for years. This is where compounding takes over. A small amount invested consistently for decades can outgrow a much larger amount invested late. Time in the market matters more than timing the market. Step 5. Automate it. The moment investing depends on willpower or motivation, it becomes inconsistent. Automatic transfers turn investing into a habit instead of a decision. Once it's automated, the real work becomes emotional, not financial. Staying calm during downturns, resisting the urge to check daily, and trusting the long-term trend you already saw earlier. Saving keeps you safe. Investing is what actually builds wealth. The path between them isn't complicated. Emergency fund, clear goals, basic knowledge, a small, consistent start, and automation. The hardest part was never the strategy, it was simply beginning.